Welcome to another tutorial video. We have a lot to cover this time around because we're going to be discussing bank regulatory capital and why some of the rules and regulations around banks did not save Silicon Valley Bank or Credit Suisse over the past month. Now, if you've been paying attention to the news at all, you know that it's been a pretty eventful past month. We've had some high-profile bank failures like Silicon Valley Bank, Signature Bank, and Credit Suisse is in the midst of being acquired by UBS as I record this. The question I want to focus on here is why did all of this happen? And specifically, right after the financial crisis in 2008, a lot of rules and regulations were passed, bank regulation was stepped up. Why didn't any of that actually stop the current crisis? And is the entire financial system about to collapse? Can we stop it? Can we do anything about it? And in general, what is going to happen next, or what should happen next here? So as usual, I'm going to give you the very short answer to this first, and then I'll expand on it and give you a lot of files and resources. If you want to get the Excel files and the PDFs and the extracts used in this lesson, you can go to breakingintowallstreet.com/KB/bank-modeling/bank-regulatory-capital, or just Google BIWS Bank Regulatory Capital. I'll also link to this in the pinned comments below this video. We have a lot of different files here, including an Excel file that we'll be going through, and then I have some highlighted filings from Credit Suisse and Silicon Valley Bank and the extracts in case you just want the shorter versions of these. So there's quite a lot to go through here. So let's start with the very short and simple answer to this question. As I put it up here, rules times people equals dumb squared. And what I mean by that is that there are a couple of issues, but it's a combination of the rules and the people themselves who are responsible for enforcing them. The post-2008 rules were really designed for the crisis at that time, which was different from the current crisis. Back in 2008, many banks entered crisis mode because of the low quality of their assets and the amount of leverage they were using, whereas the crisis now is more about interest rate risk and confidence, and banks sometimes having to sell their securities at losses because they purchased them at the wrong time at the wrong price. Another issue is that many of the requirements that banks have to follow related to regulatory capital measure risk, but they don't prevent banks from failing. It's sort of like going to the doctor and he says that your blood pressure and cholesterol and overall fitness are good, so that means you're at lower risk, but it doesn't mean that you're never going to have a heart problem or some other problem with your body. Another issue is that even when banks give you useful information, they are a bit of a black box. Bill Ackman has mentioned this and pointed to this in interviews and comments before online. And I do agree that it is quite difficult to figure out exactly what banks are doing, even with the disclosures that are required by governments. And then the last issue here is that regulators and bank management were incompetent. They were often conflicted because you often had regulators who were actually still affiliated with banks and somehow benefiting from their relationships with them. And in many cases, they were just not paying close attention to what many of these banks, especially the smaller and mid-sized ones, were actually doing. I don't think the financial system is going to collapse. I think these predictions of another crisis and of hyperinflation and all that are quite wrong. But I think we will see more sales, more failures, and possibly some more last-minute acquisitions with some of the weaker banks either failing or getting acquired outright or both. The ultimate problem here is that all of these crises and the responses from regulators are going to make the industry even more concentrated, which means that it'll be riskier in the future, because when you have 200 small banks and one bank does something stupid, it's no big deal. But when you only have 5 or 10 very large banks and one of them does something stupid, then you're in trouble because you could be affecting 10 or 20% of the people in the country. The truth is, there is no way to prevent bank failures unless you had total government ownership of the commercial banking system, which I think is a very bad idea. If the industry were less concentrated, though, and we didn't have things like too big to fail banks, then it could better withstand these failures and they wouldn't be such a big deal. So that's the very short answer to this question. In this tutorial, here are the topics we're going to cover. It is going to be a bit longer, so I'm listing timestamps for these. I'm going to start with regulatory capital for banks and what these different ratios mean and how you calculate them. Then we'll go into Silicon Valley Bank and talk about why the rules did not stop them from failing. And I'll show you some very simple things they could have done to change their approach and probably survived everything that happened. Then we'll go into Credit Suisse and I'll show you why the rules did not work here and some of the issues with these regulatory capital ratios, especially for larger, more diversified banks. And then in the last part, I'll talk about what we can do and then what might happen next. Let's go to bank regulatory capital first. Unlike most normal companies, banks expect that a certain percentage of their assets, mostly their loans, will go bad. When they issue loans, they know that some people are going to default. They know that some of them are never going to be paid back, and they expect that. To reflect this expectation, banks put these expected losses in a contra asset called the allowance for loan losses on the balance sheet, and they're netted against gross loans to calculate net loans. Let's go into my simple Excel example here and take a look at this. So here's a very simple balance sheet for a commercial bank. They have around $1 billion of gross loans, and they have an allowance for loan losses of around $50 million. Their net loans are $950 million initially, so they expect to lose about 5% of these gross loans. They expect that even after seizing collateral and using other methods, they're never going to recover about $50 million of their total gross loans balance. You can see how when we add up the total assets here, it's based on cash, securities, investments, net loans, goodwill and intangibles, and then other assets. Now, banks can change their expectations over time. The allowance for loan losses should reflect the total expected losses over the lives of all loans, but banks can adjust it up or down via another line item called the provision for credit losses on the income statement. This is a non-cash expense, and so it gets added back on the cash flow statement. Let's go into Excel and see how this works. So I have over here on the right side this loan loss reserve calculation, and if a bank expects to lose more than $50 million on its loans, it can just add to its provision. When the bank does that, the provision for credit losses appears on the income statement and reduces the bank's pre-tax income and net income. So all these fall. And on the balance sheet, the bank's allowance for loan losses increases, and so the net loans number is lower than it was before. On the other side of the balance sheet, the bank's equity, their common stockholders' equity, also goes down by the net income reduction. So this is how it typically works. And as banks expect to lose more and more on their loans, they increase this provision to ensure that the allowance for loan losses goes up to match these expectations. When that happens, equity, specifically common stockholders' equity on the other side of the balance sheet, goes down to match it. That's what happens when a bank has expected losses, but a bank can also have unexpected losses. For example, what if a loan seemed fine, but then the person defaulted and they just decided not to repay it? Or what if a bank already has its loss expectations, but they increase over time because there's a hurricane or a natural disaster or a pandemic or a war or something else like that? The issue here is that if something on the asset side of the balance sheet decreases, then something on the liabilities and equity side must also decrease to match that change. And for a bank, liabilities and equity consist primarily of deposits, debt, and equity, and maybe a few miscellaneous liabilities as well. If we go down, we can see an example right here. We have deposits, senior debt, subordinated notes, other borrowings, convertible bonds. So basically deposits and different types of debt. And then equity, preferred stock, they might have non-controlling interest or something like that. But this is what many banks' balance sheets look like at a high level. You never want the depositors to lose money. The equity and the debt investors, the common shareholders and the lenders, must absorb losses first because they are taking more risk. They are junior to the depositors in the bank's capital structure. So ideally, you want all the losses to be absorbed by the common stockholders first, then the preferred stockholders, then the different types of lenders by seniority, and depositors should be the absolute last ones here to actually take a loss. So this means that all banks need to maintain certain common shareholders' equity numbers in relation to their risk-weighted assets. If a bank expects or incurs a loss above its allowance for loan losses, it will appear in the income statement, reducing its net income. And it flows into common shareholders' equity in the balance sheet, and so net loans on the asset side goes down, and common shareholders' equity on the liabilities and equity side goes down. So let's look at a quick example of this. So if something like this happens, the bank might increase its provisions up to $20 million. And now the pre-tax income and net income are lower. And if you look on the balance sheet, the net loans number is even lower than it was before. And the equity number is also lower than it was before. And so this process can keep happening over time as the bank expects a certain amount of losses and then as it actually incurs those losses. If the bank has enough common shareholders' equity to withstand moderate losses, in theory, it should be fine. Some of the most common regulatory capital ratios based on common shareholders' equity are Common Equity Tier 1, which equals common shareholders' equity minus goodwill and intangibles, and we'll have other adjustments as well. If you go down and look here, you can see that we are calculating it by taking common shareholders' equity and subtracting goodwill and other intangible assets. You'll also see that we make it into a ratio by taking the bank's risk-weighted assets, which are based on the assets on the balance sheet times some type of risk weight assigned to each one. And then if you go down here, they also include the off-balance sheet assets as well. And we can create a ratio based on this, which is around 6.8%, around 7.3% here, something in that range. Tier 1 capital is another common one. This equals common equity tier 1 plus preferred stock. So you can see the calculation down here. The idea is that when these losses occur, right after the common shareholders, the preferred shareholders are the next ones on the list to absorb these losses. And so the tier 1 capital is available for that. These are usually framed in terms of their relationship to the risk-weighted assets. So the CET1 ratio has to be at least 4.5%. The Tier 1 capital ratio has to be at least 8%. And actually, the capital conservation buffer and a couple other buffers and surcharges increase this. So the effective numbers are actually higher. They're more like 7% and 8.5% for US-based banks, for example. If a bank doesn't comply with this, the regulators could limit the bank's dividends, their acquisitions, they could limit stock repurchases, they could even limit executive compensation, and the bank's insurance premiums might go up. And if it gets bad enough, as is the case with Silicon Valley Bank, the government might even step in and take over. Now, there are some other ratios as well. For example, there is the liquidity coverage ratio that measures the bank's liquid assets relative to its possible net cash outflows over a stressed 30-day period. If depositors panic and withdraw a lot of money, does the bank have enough cash to handle it? There's also the net stable funding ratio, which measures the stable funding, so deposits that are longer term, that are less likely to be withdrawn, long-term debt and equity and so on. And it measures that against the required funding, which is usually based on percentages of various assets over a stressed 1-year period. So there are many different ratios, but they're all related to either the bank's unexpected losses on its loans and other assets, on its liquid assets relative to its net cash outflows, and then on its stable funding relative to its required funding. That takes us to the question of why Silicon Valley Bank failed. And if you go over and you take a look at the SVB tab in the Excel file, you can see my setup here, which shows their 2 most recent annual balance sheets. And I'll use this to explain some of the factors. The short answer is incompetent management, no real risk management, failed regulators, and a terrible high-risk deposit base. Silicon Valley Bank had a huge influx of deposits over the past few years because in 2020 and 2021, startups got a lot of VC funding. The Fed and other central banks were printing money, and everyone was going around raising a lot of capital. And these startups took their capital and they put it in Silicon Valley Bank. Silicon Valley Bank served around 50% or between 40 and 50% of all tech and biotech startups in the US. However, they could not actually issue enough loans. So they got this influx of money, all these deposits, and they didn't really know what to do with them. They couldn't find enough companies and borrowers that needed loans, so they bought safe government bonds and mortgage-backed securities. You can tell that they were doing this because if you look at their balance sheet, you can look at a couple of ratios. One thing that really stands out is that their net loans to deposits ratio was only around 30 to 40%, which is exceptionally low for any type of commercial bank. Their net loans to total assets here were only around 30 to 35%, which is also extremely unusual for any mid-sized to large commercial bank. Any bank should have the vast majority of its assets consist of net loans for the most part, but that was not the case here. So just by looking at the balance sheet, you could tell that there are immediately some red flags. The company bought these government bonds and mortgage-backed securities because they thought that they were risk-free or that they were a safer alternative. But remember, as we discussed in previous videos in this channel, the risk-free nature of government bonds just refers to the default risk. All these bonds still had interest rate risk. As interest rates rose, the company kept recording unrealized losses on many of its held-to-maturity securities. These losses were not shown on the balance sheet at all, so many of its regulatory capital ratios, like the CET1 ratio, seemed fine. But if you had actually adjusted for these unrealized losses, the bank would have been completely insolvent. The bank didn't even disclose its liquidity coverage ratio or net stable funding ratio, but frankly, it doesn't even really matter because you could just look at it and tell many of these problems existed. Let's go in and take a look at this. So if we look at the held to maturity securities on their most recent balance sheet, The company disclosed in its filings that they had unrealized losses of about $15 billion on them. I have a highlighted version of the filings with some comments on the balance sheet if you want to see that. If we take this number and we subtract 15.2 for the unrealized loss, take a look at what happens. Their CET1 ratio turns negative, their Tier 1 capital ratio goes to 2%, and their Tier 1 leverage ratio goes to 1.2%. The bank is now insolvent because the minimum CET1 ratio to absorb unexpected losses is 7%. So clearly, this bank could not continue operating with losses like that. And you don't need to do anything fancy. All you need to do is adjust down the value of these held-to-maturity securities. The available for sale securities were completely fine because these are all mark-to-market value. People can look at these and quickly tell what the market value is, but the held-to-maturity ones were not, and that is what created the issues or disguised some of the problems here for people who weren't closely looking at it. So when everyone realized in the middle of March that the bank was insolvent, startups tried to withdraw all their cash at the same time. That created a bank run. The bank could not sell everything quickly enough to cover all the cash outflows, and so the government had to step in. Now, there were many ways to fix this problem. They could have hedged the interest rate risk with swaps. They could have bought shorter-term bonds instead of all long-term ones. They could have not had 100% of the customers be startups and tech companies. Or even better, regulators could have actually done their job and paid attention to what this bank was doing, even though it was a smaller bank. So as a quick example, if you use the price function in Excel and you enter Silicon Valley Bank's failure date, and then you assume something like an 8-year maturity, you assume that they purchased bonds with a 1.5% coupon rate and that interest rates then increase to about 4%, you get 83, which means that these bonds were worth about 17% less than what was shown on the balance sheet. Now, if they had just used a very simple brain-dead strategy of buying bonds with, say, a 2 or 3 year maturity rather than an 8, 9, or 10-year maturity, with the same setup, buy them at 1.5%, interest rates go up to 4%, the company would have experienced only a 5% unrealized loss in this case. And if that had happened, the CET1 ratio would have still been 8%, which is above the minimum level. If we go over here and take a look at this, let's see what happens. Let's take this and multiply by 95% to represent the 5% drop. And when this happens, yes, the CET1 ratio and all the others are lower, but they are still above the minimum levels. Also, if this had happened, even if they had had a run on the bank, let's just add up the numbers here. They would have had 129 million. That's not enough to cover 100% of the deposits. But even if 50% of the people had tried to withdraw their money very quickly, they probably could have handled that amount of demand, and at least it would have created less of a panic at the bank. Let's now talk about Credit Suisse. So the first thing to note here is that they've had a lot of risk management failures over the past 10 to 15 years. They had huge losses in 2022 of about 7.3 billion, and they've had a huge range of scandals and mishaps over the years. Now, despite all that, the regulatory capital ratios actually looked fine. Let's go back to Excel and take a look at the CS tab. The minimums for these ratios are a little bit different in Switzerland and Europe, so I've reflected these numbers here. But if we look at their balance sheet and then go down and calculate the regulatory capital ratios, at first glance, they seem fine. The CET1 ratio was around 14%. The Tier 1 capital ratio is 20%. This bank actually calculated and disclosed their liquidity coverage ratio. So on paper, it seemed like they had enough liquid assets to cover their net cash outflows in a stressed period. The problem, though, is that the company's cash and deposits had been declining significantly, and that decline was not captured directly by these ratios. So if you look at the balance sheet, you can see that their deposits were down quite significantly. This is around a 40% drop in 1 year. Their cash balance was also down quite significantly. This is around a 52% drop in a single year. These are both very concerning, and you can sort of tell that there's a problem because the liquidity coverage ratio was down quite a lot, from 200% to 144%, but the minimum requirement is only 100%. So you can tell that things are headed in the wrong direction, but these ratios designed to measure unexpected losses are not really capturing what happened with this bank. Right after Silicon Valley Bank and Signature Bank had failed, investors, the Eye of Sauron, turned their eye to the next weakest link in the bank chain, which was Credit Suisse. Once again, depositors rushed to withdraw their funds, and the bank was not going to last more than a few weeks. There were some days where they were withdrawing something like 10 billion per day. And if you just think about these numbers here, 10 billion per day when they have a cash balance of 127 billion. That gives us maybe about 12 or 13 days until the bank actually fails completely. The main lesson here is that once people lose confidence in a bank, there's no rule that can stop it from failing. Even if it keeps 100% of its deposits in cash and it never even issues loans, if people simply withdraw all their deposits, the bank is going to fail. And I have some notes in the Excel file here about how with CS, the issue was not really the held to maturity securities, it was really the rapid loss of deposits and cash and how they went down by 40 to 50% or more in a single year. Banks can fail in different ways, and there's no single set of metrics that can capture every possible cause of failure, which is why you always need to look at the full picture, all the bank statements, all their ratios to assess the potential risks. Let's go to part 4 and talk about what happens next and what we should do versus what is likely to actually happen. So I've seen many proposals from people who think that the government should insure all deposits or impose stricter requirements and regulations. I've seen people saying that it's the regulators' fault because they didn't do their jobs. I've seen proposals to create a free national bank. And of course, some people are saying that crypto will solve everything. I think that some of these ideas could be starting points for a discussion, although I think that some are less realistic than others. For example, I think that insuring all deposits is actually a really bad idea because it'll encourage banks to take even more risk. The bottom line, though, is as I said before, you can't prevent bank failures because customers could always withdraw 100% of their deposits. So I think the real solution here is that no bank should be too big to fail. The large banks, in my opinion, all need to be broken up, and we need a lot more competition in the industry. Banks should be competing to get your deposits by offering better rates and other terms and offering other services that might add value in some way. To implement something like this, one idea might be to reduce the maximum percent of deposits in the country that each bank could have. Now, currently in the US, it is set to 10%, but a bank can grow beyond this organically. This just means that in an acquisition, they can't go above 10%. But if you reduce this to a lower level, you would get more banks splitting up along regional and business segment lines and other things like that, and you probably get more competition overall. If a bank fails, that's fine, but the process and the rules need to allow a healthier bank to take over the bank and assume its deposits and liabilities and acquire its loans without too much additional concentration. The goal should be to ensure that the uninsured depositors do get their money in a reasonable amount of time. Maybe it's not all 100% available right away, but if the majority is available, then I don't think you're going to see quite as many issues with companies going to Twitter to complain and venture capitalists getting on Twitter and hyperventilating about their startups and other companies not being able to pay people. Of course, if you look at the overall trends in bank consolidation in the US over the past 100 years, there aren't too many reasons to be optimistic. As you can see, in the early part of the 20th century, there were actually a lot of new banks being created, but then in the latter half of the 20th century, this reversed, and into the 21st century, right now, there are fewer and fewer commercial banks each year. So I think we would need a pretty significant change in policy to actually see any of this implemented. We're at the end, so let's do a recap and summary. I started by going over the basic bank regulatory capital ratios and why they exist. The short answer is banks expect to lose some money on their loans, which is reflected in the allowance for loan losses. But then for unexpected losses beyond this, they have regulatory capital consisting primarily of common shareholders' equity with some adjustments. When there's an unexpected loss or an expectation of one, they record the provision for credit losses on the income statement. Net income goes down, net loans go down, and then equity on the other side goes down, and a bank has to maintain a big enough buffer to absorb these losses. There are also other ratios related to things like the bank's liquidity, for example, and there are many variations of common shareholders' equity, like the CET1 ratio, the Tier 1 capital ratio, and so on and so forth. The rules didn't work for Silicon Valley Bank because the bank was not managing itself correctly. It took in a huge amount of deposits. It didn't know what to do with them. And so they stupidly bought all these longer term mortgage-backed securities and government bonds, not realizing that as soon as interest rates went up, they would have a huge amount of unrealized losses on them. If you just look at the regulatory capital ratios, you couldn't really see the problem. But if you go beyond that and think about their balance sheet and business model, you would have seen the issues here pretty clearly. The rules did not work for CS because here, again, many of the regulatory capital ratios looked fine, but the bank was losing a huge amount of deposits and cash from one year to the next, Whenever that happens, it's a very, very bad sign because it means that if people keep withdrawing their money, eventually the bank is not going to have enough cash to cover all its deposits, and that led to the hurried, forced, last-minute acquisition by UBS. I think the main solution here is to simply break up the larger banks, encourage more competition in the industry, and make it so that even if one bank does something stupid, it does not cause all these other banks and financial institutions and companies to potentially fail. Of course, given the current state of the country and the regulatory environment, I am a little bit skeptical whether that will ever happen. But we will see what happens over the coming months and years.